Welcome to Scope's Portfolio Manager Conference session. My name is Manqing Sun, fund analyst from Scope Analysis. Today, we will tap into ESG investment in the emerging market. Now, regulation and standard of corporate disclosure across the emerging markets has long been criticized for not being stringent enough. As majorities of the companies in this region rapidly expand, so will their influence. The question is, has ESG caught up as an investment concept in the emerging market yet? Does ESG risk come with territory? The purpose of today's session is to hear about what great ESG stories the emerging markets have to tell, for which I'm very pleased to be joined by our guest speaker, Juliana Hansveden, Portfolio Manager of Nordea Emerging Star Equity Fund. She's joining us on the line today from Denmark. Welcome, Juliana.
Thank you, Manqing.
At the same time, I encourage all of you to type in the questions during our webinar. We will either answer them during the meeting directly if time permits, or reach out to you with more details afterwards. You could also view the full clip of replay on our platform, Scope Explorer. So let's start with today's session on a question by you yourself, Juliana. Tell us about yourself. How long have you been with Nordea, and what is your background relevant to the emerging market equities in particular? What is your role in the team?
Sure. So I joined Nordea in 2014 as a co-portfolio manager of this strategy, and before joining Nordea, I spent most of my time at BlackRock in London as an Asian research analyst. And that's where I started my career, and this is where my emerging market interest really began. After that, I worked as an assistant portfolio manager and a senior research analyst for global equities in Sweden at a pension fund. And then after that, that's when I joined Nordea Asset Management. And I find that our process and our way of investing, in my opinion, is the best way to invest in emerging markets. I'm very happy to be on now lead PM of this strategy. So as I mentioned, when I first joined back in 2014, I was the co-PM, and then as of early March 2018, I became the lead portfolio manager.
Great, it's very diversified profile. We know Europe is relatively well established in ESG investment, be it regulations or investors' awareness. For the past few years, we see more and more governments, especially in the emerging markets, are getting the message and making their own efforts. China, for example, has set up several targets that are considered quite ambitious from our point of view. Could you share your take on the development and perhaps landscape of ESG as investment concept?
Absolutely, and it's been really interesting to see ESG consciousness increase further, and ESG transparency improve as well in emerging markets. So, like you mentioned, China has committed to be carbon neutral by 2060, which is actually a major milestone for China, and it might seem like a very generous timeline, but actually that means that it's likely that we're going to see China's carbon emission peak way before that, obviously, and that is quite key for this development. Also, China has said that they want to focus on green technologies in their next 5-year plan, and they want to be a global leader. So I believe there's going to be lots of interesting opportunities in this space. And then a couple of other examples. So Hong Kong Exchanges, which is a major Asian stock exchange that not only includes listings of Hong Kong and domestic Hong Kong companies, but also, as I'm sure you know, a large number of China domiciled, mainland China domiciled companies.
Exactly.
Has actually been tightening its ESG rules, and doing so in a very sensible way, where they want companies to focus on what's material for their businesses, and not just have a sort of box ticking exercise to ESG. So I find that quite interesting. And then another example, Ping An Insurance, a company that itself is a large investor in the equity markets in China, is building a ESG rating system that, as far as it seems at this point, will be both available to external investors as well as to themselves. And then as a final point, we are working with our companies to become better at disclosing ESG data and understanding ESG risks. So this is also one of the things that we at Nordea Asset Management, as well as many of our peers, are pushing and discussing with companies in emerging markets how they can become better at managing ESG risks and how they can better disclose data. So this is truly something that is a trend and clear progress.
We will come to the data quality in the later part. So, but before we dive deeper, for our investors who are interested to look outside the US, could you quickly name 3 reasons why emerging markets, and does ESG matter in emerging markets? Has adding ESG truly being appreciated as a source of alpha in those countries?
Yeah, sure. So first of all, three reasons why emerging markets look interesting. So I'm now taking a step back, just the big picture, looking at the asset class, emerging market equities. And emerging markets have actually become significantly more resilient than at some other times in the past. And one way to look at resilience and lower sensitivity to external inputs is to look at the balance of payments. And the balance of payments in emerging markets, excluding China for a moment, because China has such a big swing in these numbers. So we can talk about China separately, but excluding China, as you can see on the chart here to the left, the red line is at elevated levels in a positive territory, which means that not only do emerging markets have a positive current account surplus, but also the payments flows, the financial flows are contributing to a surplus, and that puts them in a relatively stronger position as an asset class. And it also is interesting to see there to the right that actually EM performs the best, as in terms of looking at different regions and comparing them with regards to how they perform when US inflation expectations rise. The EM equity asset class actually performs the best in US dollars. And so there's both a contribution from the currency, but also in local currency. And I believe this is because in times of economic recovery, there's quite a bit of cyclicality in our universe. And that cyclicality really can come through at times of recovery and often followed by rising inflation expectations. And continuing, second slide on the topic, valuation. Yes, emerging market equities are attractively valued, and there are 2 charts highlighting this. To the left, you have the sector-adjusted PE versus developed markets, and you can see that emerging markets are at a 20% discount versus developed markets, and this is the average, actually, looking back in the period back to 1997. But having said that, that period does include a quite an extreme period around the Asian financial crisis, and we're clearly nowhere near there. So if we're excluding the period around the year 2000, you can see that actually this discount is at a low level. And this becomes even more stark if we just compare emerging markets with the US. And now, instead of looking at 12 months forward PE, we're looking at the long-term PE, where the earnings are a 10-year average earnings. So this is the so-called Shiller PE. Yeah, you can see clearly that there is a massive discount and at very low levels versus history. And then third point is the trade war, and it's almost like we've forgotten about it now, which is good. It's still ongoing. It's just in a different way. And we believe that President Biden has a more structured and multilateral approach that makes it less disruptive. And this truly matters for emerging markets. When the trade war intensified, that was followed by a correction in the market. It was one of the reasons why the market corrected in 2018. It wasn't the only one, but clearly having a less disruptive trade war is in support of emerging markets equities. And then with regards to your question in terms of ESG, does it matter in emerging markets? And we would say absolutely yes. And actually it matters everywhere. There are studies showing that, but it matters particularly in emerging markets. You can see on the slide here to the left, chart number 1. This chart shows this is a meta-analysis. So this is an analysis that has gathered a large number of studies all of the studies gathered have one thing in common, and that is that they look at the impact from positive ESG management on a company level, and then looking at the financial performance of the company, and then seeing, is there a positive link or is a negative link between these two? And as you can see, there's a positive relation in all of the regions, but the percentage of studies showing a positive link is the highest in emerging markets. More than 70% of the studies showed that there was a positive relation with regards to ESG and financial performance. So that means that to understand a company's financial outlook, we have to pay attention to ESG. And the other part is more avoiding severe risks, and it sort of goes together with this a little bit, but the allocation, the share of severe ESG risks is significantly higher in emerging markets than it is in developed markets. So it's also about avoiding those.
Okay, so let's talk about the data quality and data disclosure that we wanted to address in the first part. Actually, normally the European investors normally have, when it comes to like ESG investments in this region, they have their own concerns about data disclosure and data quality. There remains a lack of universally accepted reporting standards, and historically, let's say, emerging market has been weaker on the transparency and accuracy of data disclosure. Could you weigh on this, how to tackle that in general?
Absolutely. And you're absolutely right. There is a clear lack of consistent data, and also a lack of I guess, a regulation that requires companies to publish consistent data in emerging markets. I think that's an opportunity for us, given the fact that we have a strong in-house ESG team, and our ESG specialists support us in our process on a day-to-day basis to understand companies and what the company's material risks are from an ESG perspective. As you can see on this slide, they are a key part of the process, and the support from them allows us to conduct ESG research regardless of whether the company is publishing ESG data, or regardless of whether MSCI or any other external provider is covering the company. So that is clearly, and I believe that is one of our key differentiating factors as a process and as a team.
Mm-hmm. So I think we have covered a lot of about the region and asset class in general. Let's steer to your strategy, Nordea Emerging Star Equity Fund. Could you introduce to us about your crew? How many analysts are there to support the strategy? What are their roles and relevant background? What does the in-house collaboration look like within the research network at Nordea?
Yeah, absolutely. Here you can see our investment team. The 5 of us, we work on the Emerging Stars equity strategy, and we are specialized in different regions to make research and traveling easier and more appropriate for our universe. In addition to this, we are supported by a larger team of both a larger team of ESG analysts, but also a larger team of fundamental equities analysts. And I'll explain how this works. So Nordea Asset Management consists of a number of boutiques, both within equities and fixed income and multi-asset. And the boutique that my team belongs to, so my emerging markets team, belongs to the fundamental equities boutique, or fundamental equities team. And on this slide, you can see that we consist of a number of different teams with different skills and specialities, including thematic products like climate and social empowerment and disruption. We also have a global equities team, a European team, and so on. And the point here is that this infrastructure allows us to access specialized analysts that are specialized on a sector primarily, and that can be a true complement when it comes to us being regional specialists. So that is one of the resources that we have. And in addition to that, we have our responsible investment team that I already spoke about. This is one of the largest and most experienced ESG teams in Europe. And it is a key part of our day-to-day work to engage with and collaborate with two of the individuals on this team. One that is doing the ESG research for potential new holdings, and we use this research as a key part of our investment case. And the other person is focusing on so-called engagements. So once we have bought a company and we have it in the portfolio, this company might still have some ESG risks that are not adequately managed, and then we will engage with that company. So the other person leads these engagements.
Mm-hmm. So for our audience who are not familiar with Nordea's product lines, could you introduce your star funds concept? And here in the presentation, I see a phrase, Nordic DNA at work. What does that mean?
Yep, absolutely. So I mentioned, well, actually I didn't mention, I'll mention it now, that the Emerging Stars Equity Fund was launched in April 2011. So it's pretty much one decade ago, 10 years ago, which is fantastic. And we've been running this this strategy the same way with significant ESG integration from the beginning. And as you can see on this slide, there are three pillars that are part of this strategy. And since the let me just check. Can you hear me? Okay, I can hear some interference. Just want to make sure.
Yes, we can hear you.
Okay, perfect. Okay, fantastic. Thank you. So the fund, as I mentioned, was launched a decade ago, and since then, the so-called STARS concept has expanded into other areas and other funds. So you will find other so-called STARS fund at Nordea, and the concept is the same for all of us. So this is why we have this slide to explain what we share, what are the commonalities. And the first part, and by the way, STARS means that there is a significant level of ESG integration, a very high level of paying attention to ESG as a part of the investment process. And these three pillars of this concept are the following. The first one is that we only invest in companies that live up to our ESG standards. So whenever we're looking to buy a company and add it to the fund, we will evaluate it and conduct an ESG analysis on it, and there will be a rating put on the company. So it can be an A, B, or C. A is the highest and C is the lowest. This is our own rating. So going back to the point that we don't need external providers, we find it useful to read their research, but we don't necessarily need these ratings to be in place because we do our own work. And STARS funds only invest in A and B rated companies because that ensures that the companies have a high enough ESG standard. So that's the first pillar. The second part is that we aim to beat the benchmark, just like any other EM fund. We want to beat the benchmark, and we think that our way of approaching the market, which includes ESG integration, helps us to do that. So it's one of the contributing factors of our performance. And a third pillar is that, like I mentioned, because we invest in B-rated companies as well, there will be situations when we have a holding that has some ESG risks that we think could impact their business in the long run, and to prevent this affecting the performance of the company, and to make sure that we also benefit from this as a potential source of alpha, right? So if the company can improve its ESG profile, we believe that can also contribute to the performance of the holding. So this is the last part: create lasting impacts about engagement, and that is and can be also a source of alpha. So this is the way it works in the STARS concept.
Great. So let's come to the uniqueness of this fund. For inefficient markets, strong team on the ground and country affinity is highly important. I think you have a strong team within the Nordea, but that alone won't give the edge. If you click on the Kapital Scope Explorer, there are more than 200 funds in the tier of equity emerging markets, in which I think your fund, Nordea Emerging Stars Equity, is ranked as #1 quantitatively with top-notch rating of A. And this is very impressive, especially there are many strong players in the field. What do you think makes your fund unique or stand out compared to its peers?
I believe that there are a couple of things that makes us unique. And I believe, first of all, that this combination of high conviction emerging market investing, where we're looking to find companies whose EVA creation is mispriced by the market in the mid to long term, and that the method we use to do so includes ESG integration is key, because in emerging markets there are plenty of changes taking place, and there will be lots of opportunities for companies to capture these changes. And I believe that that pace is quicker than in developed markets, because it's not just about technological changes, it's also about a number of other structural drivers. And the fact that we focus on this and that we use ESG to identify these companies is one of our key competitive advantages. And looking at our performance, we've done it very well, and the process is able to, and has now for 10 years, identified these names. And the other point I'd like to mention is that we're long-term. So our long-term approach really helps us as well, because we don't focus on short-term noise. We focus on what creates value for companies in the long run. And that allows us to also have a relatively low turnover. From an individual stock perspective, our average holding period is 4 years. And this again allows both for significant research in the beginning. Before buying a company, we will take a good amount of time to understand and research the company. And also after we've bought it and we have it in the fund, we have time to engage with the company. And then the last one is and I think we'll talk about this later, our portfolio construction process also allows us to have conviction and to show conviction in the fund at the same time as we manage the active risk, to make sure that we have the right risk-adjusted profile of the fund.
So let's come to the performance. As I mentioned before, the fund achieved a strong performance, beating the peer group average throughout 1, 3, and 5-year investment horizons. What is your key alpha source? We do see a below peer group performance in the year of 2021 for the past 3 months. What happened there? Have you made any changes in this regard?
Sure. So yes, you're very right, and we're very proud of having a very strong performance. If you see there to the right, since inception, that's the column to the furthest to the right. We are the dark blue circle, and then the red shape is the benchmark, and then the green shape is the peer group. And as you can see, since inception, we're above the top box, meaning that we're in the top 5% of all EM funds out there, which is a great result that we're very proud of. And you see very similar levels of this dark blue dot for 7 years, for 5 years, and we're at the top of the box for 3 years. When it comes to 1 year, we're also very high. Year to date, it's a little early yet, because this is only including the month of January. I would say that yes, we've seen this interesting rotation in the market. There's been a clear recovery happening in terms of sentiment since the news of the efficacy of the Pfizer vaccine, which was back in November, which was an interesting turning point for the markets. And we believe we are positioned well for that. In terms of the positioning of the fund, yes, we have a growth bias. We also have a certain quality bias, but we can buy cyclical growth, and we have been doing so. But of course, it's still early days. And we are long-term investors, and therefore it's a little hard to comment on the past month or 3 months.
So where do you see the best investment opportunities across the sectors at the moment? Could you highlight some investment themes where you see great potential, and maybe give us some examples?
Sure. In general, one of the key criteria that we look for when we start a process researching a stock is growth. So the first thing that we're going to ask ourselves is the company likely to grow faster than EM average over the next 3 to 5 years? And that typically includes an analysis of structural growth. And there are a couple of areas that tend to come back for us in our portfolio, in our holdings, a couple of areas where we find interesting ideas. And you can see them here on the slide. Number one is technology. There are significant technological changes happening in emerging markets. They, in many ways, are quite similar to developed markets, but they often are from lower levels. So, as an example, so cloud software. Not only is cloud software very underpenetrated in EM, IT spending in general is very low. So we both have the upside from a gradual growth in IT spending, plus we have the transformation to the cloud, for example. So we usually have these very strong drivers. And when it comes to sustainability, yes, again, a similar trend we're probably seeing outside of, well, we're clearly seeing outside of emerging markets. In emerging markets, we are a little bit lower levels. So we're a little behind in terms of reaching those goals. Like we talked earlier, for example, carbon neutrality for China and so on. But that just means there's a long trajectory of growth for this space, and that can include many different areas. Yes, it would be electric vehicles and batteries for those. That's one of our holdings. It can also be about reducing energy intensity in a process or in a product, and having different smart solutions to that. And it will also be a shift towards renewables. So many different areas, and that all have the trend in common, which is growing sustainability in emerging markets. And point number 3 here, healthcare. Again, we have these like dual trends in emerging markets. So not only do we have in parts of EM aging populations, so not all of EM, but the selected parts of EM have seen a peak in their population size, in their working age population size, and are seeing more aging, the older population growing as a share of total, and that is a trend that we see in developed markets too. But here we are also we have another trend that also backs this up, which is that government funded healthcare services are typically quite poor in emerging markets. So it's not just about having a growing share of an older population, but it's also about private companies finding solutions to the fact that the public healthcare provided usually is quite poor. And number 4 is the consumer, and this is a very well-known trend, the growth of the middle class that is still going on and is particularly prevalent in China. And there's different sub-trends to this. One is premiumization. So as incomes grow, emerging market consumers look for more premium products, higher quality products, local brands, as an example. China and India, we've given their own structural pockets of growth because they're such significant parts of our universe, and we believe they have some unique trends. In China, it's one of the things that we've observed, and that we one of the themes that we have in our holdings is the consumption upgrading and also health consciousness. So this goes a little bit together with healthcare. It doesn't have to be healthcare products and services, but it can also be healthy food or footwear or sportswear that helps you exercise, for example, and that way take care of your health. So that is an example. Financial services in China also is an interesting topic because, and this goes together with the awareness of health, because health insurance, for example, is a growing industry, and that still has a lot of potential in China. So that's China specifically, and then India specifically is about growth from lower levels, where the middle class and urbanization is ongoing, but at an earlier stage than in China. So we are seeing more financial inclusion, more urbanization, the consumption of the middle class that is still smaller, but that is growing, is also benefiting from, we see companies benefiting from this trend in a similar way that we're seeing in China.
So let's take a deeper look. When you mentioned China, India, let's take a deeper look at the country breakdown. The portfolio has a large exposure, almost half, to Greater China region. And for the top 10 holdings, we see many well-known big names in the market, like Alibaba, Tencent, Meituan. This is quite interesting. Normally, these kind of big giant tech companies can barely make it to many ESG portfolios. Many strategies specifically exclude them to show resolution of a pure play. So what traits do you see in those large tech moguls? Why are they on your list?
Sure. Yeah, so here you can see our top holdings in the Emerging Stars Fund, and these are absolute levels. So these are not relative weights; these are absolute weights. So our relative weights would be, especially for the top names, significantly lower. But yeah, so some of these names have some weaknesses, absolutely, from an ESG perspective. Like, and unfortunately, I won't have time to go through that during this presentation, but in our ESG research process, we have a number of factors that we score. So this A, B, and C rating actually consists of an A, B, and C score for different factors. And one of the factors is the business models, one is corporate governance, and then you have company-specific ESG factors that vary depending on what's material for the company in question. And for Alibaba, as an example, yes, we have a C rating on corporate governance because we think that there are a number of weaknesses in its setup, and it includes, for example, the Alibaba partnership, and as an example. So yes, there are weaknesses there for sure, but the business model is rated B because it's a neutral business model. It's not a business model that detracts from a sustainable development, in our opinion. And the company also scores quite well on its other company-specific ESG risks. And this is why the company as a whole is B rated and not C rated. So it is absolutely fine, and we believe that we are absolutely okay investing in a company like that. We don't require a high rating on every single factor. And then a quite similar discussion around Tencent. I could have quite a similar where the company is rating more, higher on some factors and lower on others. But in general, we're absolutely fine owning it.
Okay. So where else do you see opportunities other than Chinese markets?
So we see opportunities actually across most of our universe. We have a bottom unconstrained approach, so we can go significantly over and underweight individual countries. But we have actually historically tended to invest in most of our major markets, and we haven't had such a big contribution from country allocation. So that hasn't been one of our key drivers of performance, and that's because we haven't deviated that much from the benchmark weights on countries. I should say on sectors is quite different, but on countries. So yeah, we find opportunities in other parts of Asia, like in Taiwan and Korea. Significant opportunities in, among other places, the semiconductor industry, because that industry is also benefiting from this bucket number one, the technological changes. We see opportunities in India, as I mentioned, and this is quite broad. India is a lot about financial services for us. We have quite a bit of exposure there, but it's also about consumer goods, among other things. Then we see opportunities for recovery in markets like in Latin America, like Brazil and Mexico, and we believe that the fact that the pandemic was managed in a quite poorly in general across that continent, Brazil in particular, means that they did suffer quite a bit. But we do believe that there is room for recovery, and we see a lot of valuation potential in that part of the universe. So actually, we find interesting opportunities across the board.
Now let's move on to risk. Emerging markets are generally of higher volatility. Your fund managed to control the volatility below the group average through 3 and 5 year periods horizon. How does the team integrate long-term conviction investing with downside protection?
Sure. So let's talk a bit about our portfolio and risk management. The way it works is, all else equal, the higher the conviction, the higher the portfolio weight. So if we have a company that scores really highly on our investment criteria, then and we really find the evaluation attractive, then that should be a higher weight in the portfolio. But there are other things we need to consider. One is the liquidity of the stock. If it's less liquid, then we will have a relatively lower weight. And the third thing is the contribution to active risk, where we're looking to spread out our active risk exposure. We're not looking for a portfolio that's driven by one or two or three stocks. We're looking for a portfolio that's driven by a number of different cases. And to get that to that result, we need to have we need to make sure that the contribution of a single stock to active risk is managed. So we're typically looking for a maximum of 5 or 6% contribution to active risk from a single holding, and then that sort of gradually tapers off into other parts of other holdings that are slightly lower conviction. And so this is how we manage the fund, and that allows us to have a more balanced portfolio. I think you're still muted. Sorry, Manqing.
Okay. Sorry for that. I think I was on mute. Let's wrap up today's discussion with your view on two questions. Did you see any new buying opportunities arises in the crisis for the COVID-19 crisis? Did you see business models render obsolete or distressed, and did this have implication on your holdings in the fund? If yes, which ones, and what did you do back then?
Sure. Yeah, we made a couple of changes early or during last year, and when interestingly in the beginning of 2020, when we started seeing the spread of the coronavirus in China, that gave us a little bit of time to think about what to do in the fund, because in the beginning, when it was Chinese New Year, there wasn't much going on anyway in terms of the activity of especially I guess consumer-related businesses in China, in terms of people taking time off and spending time with their families. So the coronavirus hadn't spread to the rest of the world yet. So that gave us some time to think, and we decided to make some changes early on. We sold out of some very sensitive names in our portfolio, sensitive to travel, sensitive to restaurants, sensitive to eating out, I should say, and we sold out of those. I would say, quite well, so relatively early. And we're happy we did that. So that was one adjustment that we did, and that was in Latin America, but also in China. So we had an airline in Brazil, for example. We had a restaurant company in Mexico and also in China, and we had an online travel agency that in Argentina. So we decided to take those out and to sell out of those holdings, and then we've gradually. The aim has been to pick up names during the correction. So we added a South African bank that had been suffering really badly because of the pandemic. We picked that up during the course of 2020. It's called Kapital, and it's a bank that targets low to middle income consumers, borrowers in South Africa, and we believe that it has lots of room to recover. So so the couple of things that happened, we sold out a couple of names quite early on because we thought they were too risky. We didn't know at that point how the pandemic was going to spread, but we believed that was significant risk. Then we've been picking up recovery names and adding to existing holdings that have suffered. So it hasn't just been about adding new names, but also adding to parts of our financial exposure, for example, that has suffered a bit. Some of these names have suffered, especially the insurers in China, that we've then been adding to. And then on the flip side, we've been trimming some of the names that did extraordinarily well last year, like e-commerce companies, online business models of different kinds. We've reduced those because they performed incredibly well. Many of them performed more than 100%. So they more than doubled. And while we haven't sold out of them, we have reduced the exposure significantly, putting the money into recovery names instead. So these are the main changes that we made last year.
It's very interesting. So when it comes to ESG in emerging markets, other than governance, what else should our investors pay attention to or look into to capture a company's sustainability? Can engagement make a difference when disclosure falls short?
Sure. I actually I do have the ESG scorecard here. So I will have some time to talk about it. You might remember earlier during this call, I mentioned that, I argued why we can have Alibaba and Tencent, and I said that there are different factors that get rated from an ESG point of view. So here you have the scorecard. You can see that what is the important thing here? The important thing is that a couple of these columns, you can see the ones to the right, business ethics, environment, and social, they have it's quite blank underneath them. It says key issue and key issue, etc. And this is because we populate with whatever is relevant for the business. So the important thing and how to make ESG matter for the investment case is to focus on what's relevant for the business, rather than just analyzing and scoring things that don't matter. For example, an online business model probably has quite a small environmental impact, and then the weight for environment should be very low, maybe even zero. Instead, such a business should be rated on data security, for example, or other key issues around the business. Whereas on the flip side, a mining company would have much more weight towards environment because of the risk of pollution, water consumption, energy consumption, and so on. So that is what matters, and that is what I think an ESG analysis should be about. And then, of course, corporate governance is really important. So it's always there with every single company. We analyze corporate governance, and the business model, in our opinion, also matters because it tells us whether the company is aligned with the sustainable development or not. And businesses might have excellent management of their ESG risks, right? So we might have let's say an example, a tobacco company that, or could be another sort of negatively contributing business model that has ESG risk that actually they manage pretty well for the industry they're in. They might do a good job. They might get a decent rating on that. But what about the business model? Just the business model itself put the company at risk. And this is why we have business model in the scorecard as well, because it allows us to align the portfolio with the UN SDGs, which we think is the right thing to do to make the portfolio perform well in the long run. So business model has a pretty high weight, 30%. Then corporate governance has a fixed weight too of 10%. So that always goes in each analysis. And then, as I mentioned, the other ones are variable. And this is what we think is the best way for rating a company from an ESG perspective.
Thank you very much, Juliana, for the wonderful presentation on our topic today and your strategy, Nordea Emerging Star Equity Fund. Unfortunately, in the interest of time, we have to stop here. In our discussion today, we heard many great ESG stories from the companies in emerging markets. And while fundamentals driving those stocks attractive, especially during uncertain periods such as the COVID crisis, they're also trying to deliver the message on catching up with ESG practice. I hope you all leave better informed and are potentially excited about the opportunities there. Thank you all for joining us on the line today. Thank you, Juliana. Have a wonderful day and see you next time.
Thank you so much. Have a good day.